think about the year ahead, Capital Group and American funds, we are calling for improved economic stability in the year ahead. That outlook is driven by strong fundamentals illustrated on this slide through a number of economic indicators. That's a fancy way of saying what we're putting on this slide is Capital Group's views across a number of indicators, and the majority of them are positive. So notably, the first three columns on the left, we are forecasting resilient global economic growth in 2026. Notably, though, we are also calling for a convergence of growth rates, meaning different regions around the world, in our opinion, will be growing at more similar rates in 2025 than they may have for the past decade. Notably, 10 years ago, the United States grew twice as fast as Europe. And again, in 2026, we see those growth rates converging through a slight slowing of growth in the US and an acceleration of growth outside of the US. In the center of the page, we'll see Fed policy. In our opinion, that is another positive for investors. So interest rates have obviously come down here over the last 18 months as the Fed has continued to cut rates. We think that continues with 1 to 2 more rate cuts in 2026. Second to the right, we show inflation. In my opinion, this is potentially one risk that Capital Group is potentially seeing a bit more elevated than what the market is pricing in today. You'll notice the industry or market consensus is for inflation of 2.6%. We see that potentially higher at 3 to 3.3. And then finally, on the right-hand side, we think that the US dollar is likely to continue to weaken in 2026. The US dollar did weaken relative to other currencies last year. We see a continuation in 2026, just not to the same magnitude that the dollar weakened last year. Outlook and good news here. What are the few things that we believe we as investors need to be mindful of in 2026? On the left-hand side, we are illustrating that the stock market today is absolutely on the expensive side of average from a historical standpoint. So 3 things that I would try to draw your attention to on the left, those light blue diamonds illustrate the current PE ratios, that is price to earnings of stocks across 5 different regions of the world. Think of that simply as how expensive is the market. A higher PE ratio means we're paying more to own those stocks today. So the light blue diamond is where we are currently. The trailing 10-year range of valuations would be the darker green bars. And then the dark colored dash is the 10-year average PE ratio for each one of those regions. Now, regardless of which region your eyes went to first, across the board, what you will notice is that the current valuations or the current PE ratios are near the tops of those 10-year ranges. And in every instance, they are above that 10-year average number. So yes, markets are a bit more expensive today, but that is also the result of the fact that we have been rewarded as investors with very strong returns for the last 3 years. So the S&P 500, which tracks the 500 largest US stocks in the US, is up 86% over the last 3 years. Right? It was up 18% last year. If you look at the other 4 regions, Japan, ACWI US, which is global markets minus the US, Europe, and emerging markets, those 4 regions are all up anywhere from 58 to 62% over the last 3 years. As we think about AI, we believe that the potential winners are essentially limitless. And it is significantly broader than just the companies that produce semiconductor chips. I would think about this slide through the lens of 1.0 on the left, 2.0 in the center, and 3.0 on the right. Now, I would argue the publicly traded names on the left-hand side within the AI tech stack have had simply parabolic returns over the last few years. Companies like NVIDIA, companies like Broadcom, companies like Taiwan Semiconductor. If you were to try to name who are the companies that are poised to benefit from artificial intelligence, those are rightfully the first names that come to mind. But at Capital Group, again, we think the beneficiaries are significantly broader. If we go to the center of the page and we look at those 2.0 beneficiaries, those are the companies that you'll find in the industrials sector, utilities, materials, the companies that are a prerequisite or a necessity to building out the data centers that are happening around the country that are continuing to benefit. I'd highlight a company like Constellation Energy in the center of the page. Constellation Energy is the largest independent owner of nuclear power plants in the world. And Constellation Energy has formed a partnership with Microsoft to use Constellation Energy to source electricity for their data centers. We own a lot of shares of Constellation Energy at Capital Group, right? And they are that indirect or second tier beneficiary of AI. And then finally, on the third column, 3.0 beneficiaries, I would tell you that this is where our investment professionals today are spending all of their time. I mentioned they do over 20,000 in-person research visits with companies across the globe each year. They are sitting down with CEOs and CFOs, and they are looking at balance sheets and saying, we notice you're increasing your spend over the last 24 months on technology. Tell me about how you're thinking about leveraging AI to either improve productivity or improve profitability. And again, this is sector agnostic. This is industry agnostic. We illustrate 3 different sectors on this page. We call out a company like JP Morgan Chase, who has already realized over $2 billion in cost savings by leveraging AI to improve their operational efficiencies. So again, when we think of AI, it's massive. In our opinion, it is not a bubble. The analogy that I've heard our investment professionals share, many of which were managing money at Capital Group 30 years ago, they said if it inflates to a bubble, that is yet to be seen. But our current environment feels a lot more like 1995 than it does 1999. And what's important there, obviously, the market peaked 99, early 2000. So the analogy is that we have some room to run.